The first 10 minutes, rapid startup evaluation framework. Building unsystematic deal flow, this episode reveals as to how to quickly separate promising opportunities from the time wasters. Learn the 5-minute pitch evaluation framework and discover the red flags that indicate immediate passes. Master the green flags that warrant deeper investigation and understand how the founders really think about the first investor meeting. This episode is for the investors who want to optimize their time while avoiding the missed opportunities. Hello everyone, welcome back to our channel and welcome back to the Capital Compass Investor Edition. In our last episode, we had built on the systematic deal flow architecture. Now hopefully you are seeing more opportunities, but here's the challenge. How do you quickly separate the diamonds from the rough without missing the next unicorn or wasting weeks on obvious passes? Today, we are mastering the rapid startup evaluation because in a world wherein the best investors see 100 plus pitches every investment they make, speed and accuracy both in the initial evaluation become your competitive advantage. The time economics of startup evaluation. Let's start with the maths that drives everything. The investor time equation. Average angel on an early VC sees about 200 to 500 opportunities per year. They make 5 to 15 investments annually, and the success rate is about 2 to 5% of the opportunities seen becoming investments. The implication here being that you need to eliminate 95% plus opportunities quickly while ensuring that you don't eliminate the 2 to 5% that could be great investments. The cost of poor evaluation. There are false positives wherein you waste weeks on deals that should never have progressed. There are false negatives wherein you pass on the deals that become massive successes for other investors. And then you have your analysis paralysis wherein you spend so long evaluating that competitive investors move faster. We have seen founders choose between investors based partly on the speed of decision making. The investor who takes 3+ weeks to give a maybe lose out to investors who give a definitive yes in 5 days. The strategic insight out here being that rapid evaluation isn't about being superficial. It's about having systematic frameworks that help you focus on deep analysis on the opportunities that are most likely to succeed. The 5-minute pitch evaluation framework. Now here's a systematic approach that can be used to evaluate any startup opportunity within the first 5 minutes. It's known as the STEAM framework, wherein S stands for size. You size the market opportunity, whether it is big enough, whether it is not big enough. T stands for team, wherein you do the founder assessment. Then E stands for evidence, wherein you look into the evidence for traction and validation. A stands for advantage, look for competitive differentiation. And M stands for momentum, look for growth and the trajectory that the company is following. The 5-minute decision tree out here. If there are 3+ strong positives, proceed to deeper evaluation. If there are 2+ strong negatives, do an immediate pass. And if there are mixed signals, request for specific follow-up information before deciding. Let's get deep into the critical red flags, which are immediate pass indicators. Experience has taught us that certain patterns almost always lead to poor outcomes. Here are a couple of red flags that should trigger immediate passes. There are founder red flags wherein you see a serial pitcher who is constantly pivoting business models without any execution. There is a blame shifter wherein you have previous failures which are always due to external factors, but they are never learning on their own. And then you have the over promoter, excessive claims about market size or competitive advantages. And then you have the single founder with the ego issues, founder who is unwilling to bring on co-founders or advisors. Then there are the business model red flags that you cannot miss. First and foremost, you have people who pitch you for Uber for X without any network effects. They have linear scaling without any platform advantages. Then you have solution looking for a problem. You have a cool technology without a clear customer pain. And then you have extremely crowded market with no differentiation, wherein you will see 50+ direct competitors with similar approaches. And then lastly, there is the regulatory nightmare, which requires changing laws or fighting entrenched interests. You also have the financial red flags, wherein you have unrealistic financial projections, you have burn rate mismanagement, unclear unit economics, and fundraising desperation. And lastly, do not ignore the market timing red flags. There are startups which are too early into the market wherein market infrastructure does not exist as yet. There are startups who are too late when the market is already dominated by well-funded incumbents. And then there are startups who are trying to launch in declining markets, wherein you're fighting against structural market trends. An advanced insight out here being about the founder psychology red flags. Watch out for founders who seem more excited about raising money than building their business. This usually indicates misaligned motivation. Next, let's focus on the powerful green flags, which indicate deeper investigation triggers. Conversely, there are patterns which often indicate high potential opportunities worth significant time investment. You have exceptional founder patterns wherein you have domain obsession, founders who have been thinking about this problem for years. You have unique insight founders who have a perspective on the market that you haven't heard before. You have an execution velocity founder who have rapid progress with limited resources. And then there is a customer magnetism wherein customers actively seeking out the startups. Second, we have the business model excellence, wherein you have strong unit economics early on. You have network effects potential. There is a scalable revenue model and there is a defensible competitive position. And lastly, there are the market opportunity signals where you have timing convergence, wherein multiple trends are creating opportunities. There is regulatory tailwind. There are policy changes which are enabling new business models. Then there is technology enablement. You have new capabilities making previous impossible things now possible. And there are behavioral shifts wherein you have permanent changes in how people work, shop, or communicate. And then there are some advanced green flags also wherein you have sophisticated matrix tracking, founders who understand their business deeply. You have customer development excellence, strong relationship with the early customers. You have talent attraction, ability to recruit strong team members despite being an early stage startup. And then there are strategic partnerships, meaningful relationships with industry players. This brings us to the market versus the team versus the execution matrix. Sometimes there are opportunities that don't fit cleanly into pass or proceed categories. And here's a framework that can be used for the mixed signals. The investment decision matrix. The quadrant 1 is a great market plus a great team. Always investigate this. The quadrant 2 is a great market plus a weak team. It's usually a pass. Then you have the quadrant 3, which is a weak market and a great team. This is situational. You need to investigate on this. And lastly, there is a weak market and a weak team, which is always a pass because no amount of capital solves both the problems simultaneously. Then you also have the execution wildcard. Sometimes exceptional execution can overcome market or team limitations. Wherein you have product execution is so superior that it creates market categories. Or there is go-to-market execution which is so efficient that it overcomes team experience gaps. And then there is customer relationship execution which might be so strong that it builds defensible moats. Lastly, always remember the pivot potential assessment. Ask yourself, if this exact approach doesn't work, how exactly could this team pivot to something that might work? Building your personal evaluation system. The best investors develop a personalized evaluation framework based on their expertise and their investment thesis. As you build your own framework, customize it for sector-specific adjustments. For example, if you're in a B2B SaaS, emphasize recurring revenue and customer retention matrix. If it's a consumer startup, focus on user engagement and viral growth potential. In terms of hardware, evaluate supply chain complexity and manufacturing scalability. For biotech, access regulatory pathway and clinical development expertise. And then you have your stage-specific criteria. If it's a pre-seed, the team and market opportunity are weighted heavily. If it's a seed stage, traction and early product market fit are the main signals. When you're talking about Series A, proven business model and scalable growth engine are the important criteria. And then there is the personal advantage integration. Your industry expertise. What do you understand better than the other investors? Your network value. Where can you add a unique value to the startups? Your risk tolerance. Early stage versus later stage investment preferences. The systematic scoring approach. You can create a simple 1 to 5 scoring system for market size and growth, which might have a 25% weightage. Team strength and fit having a 30% weightage. Product and traction having a 25% weightage, and competitive position having a 20% weightage. And then you can have a score. For example, if it's a 4+ score, strong investment candidate, proceed to due diligence. If it's 3 to 3.9, conditional interest, identify specific concerns to resolve. And then when it is below 3, pass but maintain the relationship for future opportunities. In closing, we can say that rapid startup evaluation isn't about being hasty. It's about being systematic. When you have a clear framework for recognizing patterns, you can make faster decisions while actually reducing the risk of missing great opportunities. The best investors make quick decisions on obvious passes and obvious winners, and then they spend their time on nuanced opportunities that require deeper analysis. In the next episode, we'll dive into efficient due diligence, how to be thorough without being paralyzed when you've identified a promising opportunity. Keep optimizing your investment process, and we'll see you in the next episode of Capital Compass Investor Series. That's all that we have for you in this episode. Do stay tuned in for the next one.